Welcome to Morphic Labs, and today we are going to be diving into the retail quant structural edge. We are going to be continuing where we left off at chapter 7. We already finished chapter 6 if you haven't watched my previous retail quant video. But before we get into that, do me a favor, hit the subscribe button if you want to keep up with more content like this. And if you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data, and analytics, plus an advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven hybrid methods aggregation, implementation and selection criteria. If you're interested, the links in the description, they're both basically free. You just gotta sign up to be a free member and you have them both to yourself. Now, back where we left off. Chapter 7, the conclusion of the retail quant structural edge. The compounding advantage. A retail quant generating 30% annual returns on 100K compounded monthly reaches $1 million in approximately 8 years. An institution generating 8% on 10 billion adds 800 million in the same period, but requires the infrastructure, compliance, overhead of a major operation. The personal wealth generation per unit of effort massively favors the retail approach. Now, as you can see, there is typos in this little research document that I put together, but I'm going to be giving away the retail quant structural edge open research to the market intelligence community. The links in the description. I'm not gonna be giving away this one. This is my own, personal draft one. I'll work the edges of the one I'm going to be giving away, where I just fix a little bit of the typos here, there, now give it away to the community. But back to my conclusion. The capacity constraint is not a minor operational detail. It is a fundamental mathematical law of market microstructure. The square root relationship between order size and market impact combined with the exponential nature of alpha decay creates a structural environment where small size is not a disadvantage but a profound edge. This conclusion is supported by the convergence of multiple independent research streams. Right, as you can see, the third reference, Kylie's 1985 paper, Analysis of Market Depth. The fourth reference, Bouchard's 2004 paper, Fluctuation Response Framework. And I'm not going to get into the details of the references. I'm going to leave that for the community members to look through the references themselves, of where I get the numbers, where I get the conclusions that I'm making, and all these statements that I'm making, right? The references are in the document. I'll be giving it away, but that's not my point here. And essentially, this conclusion is supported by all this research, right? The retail quant opportunity space can be summarized through 3 core principles. Number 1, invisibility is alpha. Market orders that execute without moving the bid-ask spread capture the full predicted edge. Every basis point of slippage avoided is a basis point of alpha preserved, right? Essentially, you're trying to ride market impact, not create market impact. There's a retail quant, of course. As Mattel 2008 documented, institutional orders routinely suffer 15 to 40 basis points of adverse selection costs from information leakage. The retail quant pays no such tax. Number 2, smaller is smarter. The constraint of limited capital forces focus on high conviction, rigorously validated strategies. Right? You can be, pulling out a moving average and waiting for it to cause some exponential moving average or that's just below it. You have to actually come up with validated strategies, right? Strategies that are worthwhile. The institutional imperative to deploy billions necessarily dilutes research quality. Grimold and Quant 2000 formalized this through the fundamental law, which shows that the information ratio degrades as the breadth of bets increases beyond what the research process can support with high quality signals. Number 3, time is asymmetric. The retail quant's millisecond execution capability versus the institution's hour-long T-web algorithms represents a fundamental information advantage. Observer and Wang, I hope I'm not butchering his name, I'm sorry if you're watching this, 2013 demonstrated that the optimal execution strategy depends on the dynamic properties of liquidity, and that small orders can be executed instantly within the existing liquidity pool, while large orders must wait for liquidity to recover. The ability to capture a signal before it decays is the definition of alpha. The retail quant advantage equation. The total structural advantage delta of a retail quant over an institution can be expressed as delta equals the difference of I of A sub institution difference I of A sub retail, this is called the impact edge, plus alpha of tau sub retail difference alpha of tau sub institution, this is the speed edge, plus U sub retail difference U sub institution is the universal edge, where U represents the number of tradable instruments. For a typical micro alpha strategy, or for typical micro alpha strategies, delta can exceed 500 basis points per trade. The implication is clear. The retail quant does not compete with institutions. They operate in entirely different markets. The institution's sledgehammer cannot access the precision work of their scalpel. The path to outsized returns lies not in scale, but in the disciplined exploitation of structural invisibility. Trade with precision, compound with patience, remain invisible, and this is not financial advice. Okay, it's just information. And that's about it for today. And that's actually about it for our retail quant structural edge. The references for all the details, numbers that I provided in my retail quant videos are over here. This document will be given away to the community members, the free members on the Discord. If you're interested, just sign up to be a free member and you'll also have this for yourself. But that's about it for today. Do me a favor, hit the subscribe button if you want to keep up with more content like this. And if you're interested in increasing your market intelligence, I have a free market microstructure and trading systems course that will walk you through the foundations of market structure, the mechanics of trading, market data and analytics, plus an advanced market aggregation course that will walk you through advanced price-based aggregation, volatility-driven aggregation, information theoretic aggregation, order flow and microstructure aggregation, event-driven hybrid methods aggregation, implementation and selection criteria. If you're interested in that, the link's in the description. Just gotta sign up to be a free member and you'll have it all to yourself. And that's about it for today. I am out. Bye.